Chapter 16, Real Estate Closings. This is my favorite section, I've got to tell you. What we're going to be dealing with here is calculating a number of things. This is going to be probably the largest portion of your math section. I hope everybody in here knows how to calculate or how to transfer a percentage into a fraction and vice versa. I think from a testing standpoint, you're going to need to know how to calculate a commission. And just remember that the way that they're going to pose these commission problems, it might very well be you've got to determine, first of all, what is the sales price, not what the listing price is. It might very well be that they give you both. Your commission is based on the sales price, not the listing price. Now, if they don't give you both, then you'll have to go with what they've got. You'll have a total gross commission, and then you may have to determine, which portion goes to the sales associate, which portion goes to the broker. As far as the preliminaries in any kind of closing, there will be a number of things that we're going to have to understand and know. There's going to be inspections done, but from a testing standpoint, let's get to the heart of it. There's going to be two portions that you're going to need to know: expenses and prorations. So let me first of all start out by talking about what a debit and a credit is. The easiest way to remember the difference between the two: a debit is any time that someone in a closing, either the buyer or the seller, either has to pay money or does not get money. That's a debit. A credit is any time that a party in a closing, buyer or seller, either gets money or is relieved of having to pay money. That's a credit. An easy way to remember the difference between the two: a debit is a sad face. A credit is a happy face. If you're an accountant or an accounting major, this is going to be confusing to you. But for the rest of us, it's just a basic. If it makes you happy, that's a credit. If it makes you sad, that's a debit. Now let's talk about the proration. As far as prorations are concerned, typically a proration is an item that's going to be shared between the buyer and the seller. Your big prorations that we'll be dealing with is going to be real estate taxes. If the property is a rental property, we'll probably have rent that we have to prorate. If there's a mortgage involved, there may be an interest that has to be prorated. So we're going to have some items that are shared between the buyer and seller. When we're dealing with prorations, we have to determine whether we're using the 365-day method or the 360-day method. What's the difference between the two? The 365-day method, there are 365 days in the year, and that each month has the number of days that it's supposed to. January 31, February 28, March 31, and so on. Using the 360 method, every month has 30 days. Typically on the exam, they're going to tell you whether it's the 365 or the 360. The 360 is sometimes known as the 1230 method as well. If they don't tell you, it's going to be the 365 method. Now, as far as an expense item is an item that we pay to somebody outside of closing, somebody that's not part of the buying and selling process. It could be the real estate broker's commission. It could be doc stamps and intangible tax to the state. It could be surveyors. It could be appraisals. It could be any number of things, money that we pay to people outside of closing. Now let's talk about prorations, because you'll probably have a proration problem that you're going to have to deal with. The easiest way to do a proration, this is so simple. I want you to first draw a timeline. The seller has the first half, the buyer has the back half. I want you to mark on there somewhere a day of closing and who it belongs to. Then what I want you to do is post on either side, whichever side, it depends on what it is, when this bill was either paid or due. Real estate taxes are paid in arrears, so it will show up at the end of the timeline. Interest on a mortgage is paid at the end of that timeline. Now, if it's a rental property, rent is typically paid up front, the first of the month, or whatever that period is. So rent would be paid in advance. And the best way to do a proration, I want you to remember, please, a proration is one amount of money that one person is paying to another. It's never two amounts. I owe you a certain amount of money. If that bill is paid or due at the end of the term or at the end of the timeline, go down the timeline because you're looking for the front of the closing period. If it's paid up front, walk down the timeline, you're looking for the back. So remember that if it's paid in arrears, look to the front of the timeline. If it's paid in the front, look to the rear of the timeline. In every case, and there are no exceptions. Remember again, one amount of money that one person is paying to another. And the easiest way to do that is simply plug in that particular amount, whatever it is, divide by whatever you're supposed to divide it by. If it's a 365 method, divide it by 365. And then multiply it times the number of days that you're looking for. Just leave it in your calculator and let it flow. If you take it out, there's an old saying, there's a penalty for early withdrawal. So once you punch it in, leave it in and let it go. As far as taxes and transfer taxes for closings, you're going to have 3 taxes that you may have to deal with for the closing section. The documentary stamp on the deed, the intangible tax, and the documentary stamp on the note, on the promissory note, or notes. The documentary stamp on the deed is based on the purchase price and is calculated by taking the purchase price, dividing it by 100, and multiplying it times 70 cents. It's 70 cents for every unit of $100 of the purchase price. When you divide it by 100, if you see any fractions in your calculator, you got to pull it out and round it up. For instance, $88,240. Well, that $40, when you divide it by 100, comes out as a fraction. So you have to pull that out and make that 283, if you follow what I'm saying. So anytime that you have a fraction, you've got to pull it out and round it up to the next nearest 100. As far as the intangible tax, that's on mortgages only. And anytime that you create new debt for closing, there's going to be a mortgage involved. That's the collateral instrument. That's calculated, the mortgage amount times 2 mils, 0.002. Remember that a mortgage cannot exist unless there is a debt. So when you see a mortgage tax, an intangible tax, you know there's got to be a promissory note somewhere. So whatever amount of mortgage there is, there's also have to be an equal amount of promissory note. The promissory note is based on all new debt created at closing and also any assumption. Anytime that we have an assumption, the lender is going to require the new buyer, the new borrower, to sign a note and become legally responsible for the debt. That's the reason they do that. So the calculation for the documentary stamps on the promissory notes is 35 cents for every unit of $100, and any fraction, you're going to have to round it up, just like in the doc stamp on the deed. The doc stamp on the deed and the doc stamps on the note are both divided by 100. Remember that the doc stamp on the note or notes is half the price of the deed, 35 cents versus 70 cents. And the best thing to do is just calculate them separately. So the doc stamp on the deed, 70 cents for every unit of $100 of the purchase price. The intangible tax on the mortgage is 2 mils times the new mortgage amount. The doc stamp on the note is 35 cents for every unit of $100 of both new notes and assumed debt. Those are your calculations. Now there's a rule of thumb that we use to determine who pays what at closing. Typically, any time that a seller has a deed, the seller pays doc stamps on the deed. Anything having to do with a mortgage, typically the borrower pays for. Now let's talk real quick about debits and credits to buyers and sellers. The purchase price is always going to be a credit to the seller and a debit to the buyer. If you think about it, the buyer's giving the seller money at closing. Sad face, happy face. The binder deposit is always going to be a credit to the buyer, and the reason for that is the buyer has already put up the earnest money deposit as part of the offer. So that's money they don't have to come up with at closing. So that'll be a credit to the buyer. That's a happy face. Also remember that any mortgage that we're dealing with, that's money that the buyer does not have to come up with at closing. Now they may have to pay it later, but it's money that the buyer will not have to pay at closing. So all mortgages will be a credit to the buyer. All mortgages that have to do with the seller will always be a debit. That's money they will not receive at closing. And that includes assumed debt as well. So those are your rules of thumb as it relates to the closing. Remember that a debit is money that's owed. A credit is money that's received. A prorations are items shared between the buyer and the seller. Expenses are monies owed to people outside of closing. Documentary stamps are 70 cents for every unit of $100 based on the purchase price. The doc stamps on the promissory note is 35 cents for every unit of $100 based on all new notes created for closing. That's both new and assumed. The intangible tax is 2 mills times any new mortgages created at closing. That's .002 times the new mortgage amount. Mortgages are always debits to sellers and always credits to buyers. And this is the end of this chapter's review.